Welcome back to our final part 3 of CIOs and bow ties. As I said initially, a bit of a different version. We're focusing here on tax alpha. My guest is Frazer Rice, author of the book Wealth Actually, and he is also with, I think it's a Pendleton Square Trust Company, and he's also had many, many years working with Wilmington Trust, an LLB by qualification, and avid golfer. Hope you've been able to get out on the links, Frazer, with COVID and whatnot going on.
It's the one thing that they seem to allow without much restrictions. So I've gotten out there a little bit.
Terrific.
So it's good.
That's great. Yeah. Okay, let's switch to some programs, if you will, around tax planning. So why don't you take it through? I know you've mentioned a few, so let me not even preface it. Why don't you just take us through some that are popular and some that you guys offer to clients?
Sure. So I'm going to start with the first one, which I think is one that is tried and true, and that everyone who is looking at a big tax bill probably should have in front of them in one way, shape, or form, and that's private placement life insurance. As many people may or may not know, but life insurance essentially allows for tax-free growth of the assets that support the life insurance policy. And then there's a lot of different, I guess I would say, optionality in terms of using the cash value of those policies you borrow against them with the idea that when you die, you'll pay that loan back. Those proceeds are essentially tax-free. And I say that with a bit of an asterisk. But that that overarching concept of using a life insurance chassis to get income and capital gains tax relief for certain assets is something that is it's becoming extremely popular within the high net worth and ultra high net worth set. It's always been popular as a way to deal with estate planning concepts. We'll take a step back. Life insurance generally has a couple of different functions. For the first one, most people use it with the idea that it's an income replacement for family in case something goes wrong. The second way people use it is as a way to fund estate taxes. So if you have $50 million and you have a $25 million estate tax hit, there is the idea that if you have a certain amount of life insurance to cover that, that helps to preserve your estate. And if you run the numbers and buy your life insurance correctly, you're killing two birds with one stone with the income replacement and the estate tax component. The third part, and this is controversial to some, is the idea of life insurance as an investment or as an asset class. I think that the way it's evolving, private placement life insurance is getting a lot more attention as an after-tax asset class, especially as income taxes are rising. If you're able to invest proceeds into life insurance, get that tax-free buildup and accumulation, and then tax-advantaged withdrawal rights, loan capabilities, et cetera, that's a product/feature that, if structured correctly and filled with the correct assets, can be interesting to think about for some people.
What is the private placement component of it? I mean, I'm used to private placements as in, private transaction. But what is that?
Yeah, so essentially, private placement within the state regulation of different insurance, and so life insurance is regulated at the state level. Certain investments are permissible, and as the market has gotten more and more sophisticated, things like hedge funds, things like private placements, things like contributing certain assets into private placement life insurance policies, that's becoming more and more in vogue. It's not, it doesn't necessarily have to be just stocks and bonds anymore. There are different components that can be put into private placement life insurance policies, and that's what's getting a lot of interest from people. So as they're trying to reach for return in a after-tax environment, having that chassis in place is an interesting component. I don't like to call it a Roth IRA type substitute, but it's similar in nature. It provides different functions. It has life insurance functions, and it has sort of investment functions as well.
Is there a kind of cash surrender value as well, so you can kind of redeem through a cash surrender?
Yes. So, and again, this gets to the notion of, there's sort of, to get back for your listeners, there's term insurance, which is what a lot of people use purely to replace income. So you pay a low level of amount, and essentially that term ends, you don't have anything to show for it. You were just paying a smaller amount of premium in order to replace the income. That goes away. Permanent insurance, under which I would say universal and whole life, they fit into that background. Those are the areas where you're paying more in premium, but the insurance policy is generating cash surrender value. So the concept of private placement is sort of taking these universal policies and instead of having them invested in fixed income and growing at a smaller amount, you're really trying to ramp up the investments underneath the insurance policy and increase them accordingly. Got it.
Okay. The next one I know is a little bit of a controversial one, so take us through it.
Okay. So conservation easements. And so this is something
especially down here, by the way.
Oh, they are a big deal in the South. And they're starting to get more attention in the North. So the concept of a conservation easement is, in a sense, a pretty easy one. If you have, let's say, 100 acres of property, and you take 100 acres and you conserve it, you put an easement on it for the purpose of land conservation, which is I think, a very admirable goal, and something that, as this country continues to get more and more developed, that it's really, something it's a useful program. You can get the value of that conservation easement and use that against your tax return, or use that in your tax return to net against current income. So if you had 100-acre property and you donated it to one of the various land trusts around, and there's a value ascribed to that property, that value is a donation essentially, and goes against your tax return. So that's not that controversial. What is controversial, in many ways, is the establishment of that value. So if you have 100 acres of swampland that you conserve that didn't really have a commercial purpose, let's say you get $100,000 of value on that front. On the other hand, if you ascribe a more commercial value to that property, and let's say it's maybe out of that 100 acres, maybe 1 acre is swampland and 99 acres is something where you could put a solar farm or develop mineral rights to it, you can put a higher valuation and therefore get a larger deduction for that piece of property. So getting good realistic valuations for conservation easements, that's fine. That's not that controversial in and of itself either. So if you go in and say, okay, here's 100 acres, I could, in theory, put a 99-acre solar farm on it that could generate X amount of dollars, and that has a certain amount of money. So instead of $100,000 before for just raw land, you now have something that maybe is worth $1 million. And so by conserving that, you take that valuation and you put that against your tax return. So what invariably, the next step along that, and this is where it does get controversial, is when you take that same concept and other investors, through syndication essentially, pay into a fund at the $100,000 level, and then later that solar valuation comes into play, and then different people, in a sense, are able to take advantage of that different deduction. And so the controversial part is the idea that someone could essentially, for a very limited amount, buy a larger deduction for their own tax return without any technical increase in value necessarily. So What's tricky about that is that you're using concepts that make a lot of sense. The idea of conserving land is a noble idea. The idea of taking a deduction is a good one. The idea of taking a deduction for a highest commercial purpose is also a good one. I think the IRS, it's a transaction that the IRS is definitely scrutinizing. What's happened is I think that the controversial part is that the valuations have been, in some cases, really, I wouldn't say abusive, but pretty darn bad. So if you take $100,000 property that's just raw and you say, well, I'm going to mine, plutonium out of it, and I'm going to put $1 billion valuation on it. Oh, and by the way, I'm going to sell that to a bunch of different people. That doesn't look right. And I think that's what the IRS is trying to scrutinize. So what I tell people, they come across my desk, what I tell people on it is, say, look, you're going to get audited. The original deal is probably going to get audited as well. And I would just be ready for it. I think in some cases, when valid. So first of all, I think on one hand, the I's have to be dotted and the T's crossed to a level of perfection that you have to just make sure, you have to make darn sure that's right. So assuming that the form follows the function on that front, the next thing is to make sure that the valuations are reasonable. And so if you have a piece of property that could realistically be dedicated toward a solar farm, let's say, and many could, make sure that the valuation reflects that correctly. And I think I don't think you're doing yourself any favors by being by playing huge reindeer games with valuations on that front. That's what that's what ultimately,
that's what gets you in hot water. Yeah.
Right. And, and if someone comes to you with one of these deals, I think the important thing to think about, if you're going to go that route, is to make sure that the deal itself, the people who are sponsoring it and putting that forward, that there is a large pool of, or that there's a pool of defense assets within the fund, because the IRS is going to come and take a look at those valuations. And you want the transaction to hold up. And I would try to be around as many good actors as possible on that front, and just understand that that there may be that donation, that conservation easement that could net against your tax return. That's something the IRS is going to take a look at, and probably take a real hard look at it. Yeah.
Okay. Yeah, we've got some stories around that, but they're pretty self-explanatory based on what you've just said.
Right.
Take us through solar power development now. I'm going to have a shameless plug here. I have another guest coming on in a couple of days' time, a gentleman by the name of Stu Kaplan, who's with Apex Financial Advisors, and he puts together these solar deals. He's really a real estate guy, and they've been putting solar panels on top of parking lots and the like. And so he's going to walk us through one of these deals in kind of a great detail, talk about the tax credits, the ROI, and off-take agreements and stuff. So really interesting and gaining a lot of popularity. So tell us a little bit more about some of these solar deals, please.
Yeah, so I'm not going to take too much of his thunder away from it, but the concept behind the solar deals is that there are investment tax credits and the acceleration of depreciation that are particularly interesting in beyond the merits of the solar deal itself, which is a power generation capability and being able to sell electricity to the grid. It has its own business components to it that are that I think are novel and hopefully hold up on their own right. But essentially, what gets people thinking about solar as both as an investment and as a potential use of tax credits, the idea is that you get above average yield with tax incentives. The tax incentive is a 26% investment tax credit and an accelerated bonus depreciation. So investors are able to use the ITC and the accelerated depreciation during year one. So if the deal is right, you're able to take these types of things and move them off. The benefits can be rolled forward for 20 years, and they can be used against the previous tax return year as well. And then after 6 years of operation, the investor may choose to sell or hold that solar development. I mean, that's basically it. You get the potential benefit of accelerated depreciation. You get the benefit of a 26% tax credit, and hopefully you have an underlying investment piece that is something that's useful in your portfolio above and beyond just sort of the tax tail wagging the dog.
Yeah, yeah, they become very popular. So we'll get into that in more detail. But thanks for the primer there. Okay, we're gonna do a quick rapid fire session, Frazer, and then we'll call it a day. You've been very generous with your time, and I appreciate that.
I have one thing that I forgot, which is for people who are in high tax states, not New York, so California, New Jersey, and other ones. There's the concept of non-grantor trusts. So for just a quick background, so for trust planning, a grantor trust is a trust where the grantor or the settlor pays the taxes. A non-grantor trust is when the trust pays its own taxes. And as part of income tax planning that's becoming more sort of in vogue right now, and with the idea that California income tax is looking at becoming 16+%, the idea of residents putting assets into non-grantor, meaning the trust pays the taxes return, in states that have no state income tax, that concept fulfills some estate planning functions, but also fulfills some income tax planning functions. So states, Delaware, Wyoming, Nevada, Tennessee, they have the capability of having non-grantor trusts where if there is enough separation of nexus, meaning that let's say a California resident has as little in terms of ties to that trust, there may be some income tax planning that can be achieved there. So I throw that in there. That's something that for people in high tax states, they should be asking their estate planners about, and their general advice folks. And that comes with a caveat that in New York, it doesn't exist. New York legislated that capability out, but at the moment, it still works in some other states. Okay.
Thank you. Appreciate that. Okay. Rapid fire session quickly. Selling a business. How would you advise a client? Small business, medium-sized business, any advice you could provide?
Purely on the tax angle. There's two components. Again, the idea of using jurisdictional arbitrage to sort of take your affairs out of a high tax state and put them into a lower tax state or a zero tax state. From a trust perspective, I would be thinking about that. Now, there is a huge caveat to all of that. So if you have and the caveat is something called source income, meaning if the business is generating generating income or generating return within a certain state, that you're going to have trouble moving those. You're going to have trouble sort of avoiding state tax on that front. Great example of that is real estate. If you have a building where people are paying you rent, you can't move that to a Delaware corporation and put it in a Tennessee trust and expect New York to say that that's not something that we tax. So source income is an issue for business owners. However, if you are a Bitcoin trader or if your assets are intangible, and I would say IP, royalties, things like that, I would really look hard at thinking about locating your assets and structuring your affairs in a way that uses that jurisdictional arbitrage between, say, a New York and California versus a Tennessee or Delaware that have no state income tax. There's a lot of people who talked about moving to Puerto Rico if they were day traders and things like that, because there's even advanced sort of avoiding federal tax issues.
Federal, right? Yeah.
Now you have to make a big lifestyle choice in moving to Puerto Rico, and you have to go through a lot of different hoops, but that's an idea. But for those people who are sort of more comfortable within the continental U.S., there are a lot of great places to be where you can enjoy zero state income tax and zero capital gains tax without necessarily giving up the state where you grew up in and that type of thing, at least on a total basis.
Okay. You already hit on my Puerto Rico question, so we'll cancel that one out. Here's one, probably not directly related, but I'd love your comment on it because I think it's, well, the Volcker rule, as you know, was recently rescinded or, taken back in certain forms or another. Now, you and I are well aware of the Volcker rule because we lived through the 2008-2009 crisis, and Volcker rule was essentially put in place to do a lot of things, but primarily to stop banks from making, principal bets, investing in their own private equity and their own, balance sheet kind of thing. Right. Again, there may be no tax implications that we can think of straight away. I certainly think there are unintended consequences, but it seems to me that by rescinding the Volcker rule, we're just returning back to that, those days of the early 2000s where investment banking was all popular because they were using their balance sheets to make bets and stuff. So I guess it's more of a comment around the banking environment from which we've come and gone. But again, any loose thoughts around that?
Well, my thoughts evolve on this topic all the time, depending. I feel like the banks are about to walk into a very difficult situation right now, especially ones with a huge degree of exposure to commercial real estate, exposure to all sorts of things where sort of liquidity benchmarks and capital requirements may get tested a little bit. I think the banking industry learned a great deal from 2008, and so I think that their capital backstops are well established right now. And so I think we're actually uniquely well prepared from a banking perspective to deal with what we're dealing with right now, I hope. I'm a big believer. I go back to sort of Graham Leach Bliley and the idea of the financial supermarket and everything's under one roof, and all the smart people are under one roof, and I don't believe that anymore. I think separation and competition and lots of firms. I think that's healthy for the system overall, and that the consolidation of firms, provides some scale, but it provides real danger for sort of the cross sell and conflicts of interest that we see pop up. And whether there's conflicts of interest, especially in a big time corporate setting, I think that's how mistakes get made, and then you have blowups, and ultimately lots of blowups leads to systemic risk, and systemic risk is what you really want to avoid. And I think you avoid some systemic risk by having a lot of medium-sized firms and having that separation in place. But and it's a balance, and it kind of depends on whom you're dealing with. I mean, I think we all kind of like the idea of having Jamie Dimon at the head of JP Morgan and having an institution with that kind of heft able to provide leadership with some of the other big institutions around certain things when maybe the government isn't providing that leadership, or is becoming more informed about the scenarios that are in place, especially as it's complicated and you have huge exposures with derivatives, et cetera, that are so very difficult to understand even for experts. So, banking system, I would say, just in summary, I think I'm comfortable with where we are. I think the banks are well capitalized. I think that I tend to think that a larger number of medium-sized banks is a healthier thing for the country. Yeah.
Okay, just more of a commentary on that side of things, not really a tax question. I granted, I can almost see it as sowing the seeds of the next crisis, if you will, because if you think about it, right. What's going to stop somebody? And I'm actually quite bullish on banks as a result. So two things. First thing is, part of the rescission of the Volcker rule was actually the relaxation of collateral behind derivative transactions, swap transactions. So that just puts more leverage in the system. the other thing is, what stops some young buck or, a few guys now from buying an FDIC bank and essentially going and borrowing at the Fed window at whatever basis points, and then, lending that into their private equity business or their, whatever, real estate private credit business for that net interest margin, yay big. So, just playing the balance sheet game. So I suspect that will happen.
My other comfort on that is that buying an FDIC insured bank is a real pain in the butt. And it worked for Wilmington Trust, now owned by M&T Bank, and it took them 3 years to get a Hudson City merger through. I have, if there's one government agency that I have real confidence in, it's the FDIC. Because they know that they have the biggest responsibility out there, because if something goes wrong, they owe up to $250,000 per account. And they don't fool around with that. And so if you get some real maverick who thinks that they can go buy up some banks and then use the balance sheet for something else, maybe you could, but those folks in particular, I think that's you're dealing with the fundamental foundation of this country when you start messing around with that. So I feel like they take that. No,
good point. Okay, we're going to end off on one last. A lightning round became, let's say, more of a rolling storm round. It took a bit longer. Last one, again, just one that I came across that's kind of interesting. I think it was in some recent tax amendment bill where it allowed you to carry back. You have to correct me on this, but carry back losses, I think, further than you could before, or amend and actually get a tax refund, as it were. Is any of this ringing a bell, or am I just?
I think I read something about that, but I can't talk intelligently about it. I know that the idea of taking losses and expanding their use is always interesting certainly for taxpayers, and it's sort of an interesting cherry to dangle in front of people that doesn't cost the IRS or the state tax authorities that much, because it's only a very few number of people who are going to take advantage of something like that. But I think the idea that there are going to be losses, people are going to have losses, they're going to have lower incomes theoretically this year. Certainly the 1099 folks, if the slowdown of work is in place, certain sectors, of course. So they're going to be people looking at taking losses and writing things off. And I think the intelligent ones too are going to be sort of saying, okay, here are losses this year that I can carry forward into next year. So anything that maximizes the leverage of those losses is something to be considered.
Great, man. Listen, I'm always reminded by the fact that the tax code, I think, is 10 times longer than the Bible, both the Old and New Testament. So it's interesting that we can go so long talking about taxes. So, Frazer, listen, always a pleasure to speak to you, to see you again. I'm glad you're doing well. And, lovely chat, good information as always. I wish you all the best, and thank you for coming and joining us again. And let me just leave the mic to you for any final words.
Sure.
Before you do that, I would just say, if anyone wants to get hold of Frazer, his contact details will be appended to the podcast. Otherwise, just feel free to come through me. Happy to make an introduction to Frazer, and then as a result to Pendleton Square.
Greg, thanks for having me on again. Hopefully I passed this audition too. And
the third time's a permanent one.
Yeah, right. That's right. So, but I appreciate being on, and I just for people out there, I would impress upon them that this one component with the way things are sort of surfacing right now, I think the last quarter is going to be one of the busiest as it relates to tax planning and estate planning. So if you have thoughts about reviewing things, I would get going on it now. I think August is a perfect month. September is a good month because once September 15th and October 15th start rolling around, the accountants are going to be really busy. The estate planners, the estate planning attorneys and so on, they're already busy. So I'd get it done. And there's always an issue with places running out of tax ID numbers or trying to get accounts open or KYC. So if you leave it until December, you run the risk of not getting it done real well. So now's the time to check this
advice.
out.
All right. Thanks, Frazer. You have a good day and you take care of yourself.
Likewise.
Bye-bye.
Take care, Greg.